Good evening, everyone, and welcome to the Brian Crombie Radio Hour on Saga 960. So, cryptocurrency, FTX, etc., has been a big issue in the financial markets and I think personal conversations over the holiday season. I read a really fascinating column in the paper a little while ago by Sam Sivarajan, and he wrote about FTX, and it was really quite an interesting article. Sam Sivarajan is the author of two best-selling books. He's a behavioral scientist, and he has led wealth management teams for large Canadian financial institutions. He's also a columnist for The Globe and writes on investing and personal finance topics. As I mentioned recently, he wrote an article on FTX. FTX is this leading cryptocurrency exchange, and its bankruptcy has some real lessons for not only investors in cryptocurrency, but investors at large. Sam's going to speak today about the FTX situation, what happened, and what investors can learn from it. And I'm also going to ask him to speak more generally about the market in 2023, what investors can think, what he thinks about volatility, how he thinks we can make some money. Sam, welcome to the show, sir. How are you?
Brian, very well, thank you. And thank you for having me on the show.
Excellent. I really appreciate it. This article that you wrote on FTX was really fascinating. Tell us a little bit about the FTX saga, if you could.
Well, thank you. Yes, FTX, as your listeners know, and as you alluded to, is one of the largest cryptocurrency exchanges in the world when it filed for bankruptcy in early November 2022. What makes this an interesting case is that it was one of the fastest and largest implosions in business history. A month before, FTX was worth over $32 billion US.
$32 billion.
$32 billion. And its founder and CEO, the young Samuel Bankman-Fried, or SBF as he is known, was personally worth over $15 billion. Now, today, he is bankrupt, has been arrested, and a trial for fraud is on the horizon. But ironically, and this is the point that I tried to make in the article, none of this is new. We have seen this situation in the past, and unfortunately, we will see it again. And that was the key point I was trying to get at, and drawing some lessons, key lessons for investors so that they can avoid the next FTX.
In your article, you outlined 4 lessons. Tell us what those 4 lessons are, if you could.
Sure. So the first one, and obviously there are many more, but let's focus on the 4 from the article. So the first was beware the celebrity CEO. So let me give a few examples. Theranos founder Elizabeth Holmes promised a technology that could run countless medical tests out of a single drop of blood, was regularly on the covers of magazines and on television. In fact, she was touted as the next Steve Jobs. The company failed largely because the technology just didn't work, and she was convicted last year of fraud. WeWork, the shared workspace company, was valued as high as $47 billion in 2019 before a failed IPO. Adam Neumann, WeWork's charismatic founder, was also on the cover of magazines and viewed as some kind of visionary, until people realized that this was just a real estate play and that there were similar companies that did the same thing while making a profit and yet valued more attractively. So I think the key lesson here is that investors should look past the hype and celebrity status surrounding charismatic founders and CEOs to check the fundamentals of the company.
Is there a lesson there for Elon Musk?
I think there's a slight difference there. I think Elon Musk, whatever one may think of his personality and his outspokenness on media on all topics, etc., there is a valid company that he's got. I mean, he has achieved some fundamental things, etc. So I'm not trying to say that fame or brand or name is not something. I mean, Steve Jobs had a large personality, but no one can fault what he's done with what he did with Apple. So I think my point is not that a big brand, personal brand, or a lot of celebrity is in itself a reason to run away from a potential investment. It's just something that should be a signal to people that they should look behind the curtains to see if there's some substance behind the facade.
Okay.
The second lesson that I talked about was do your own due diligence, do your homework. So your listeners will probably recall Bernie Madoff and his hedge fund, and what he was famous for was the largest Ponzi scheme in history. He defrauded investors of over $65 billion. And what was remarkable, Brian, was that he managed to get away with it for decades. And one of the reasons he got away with it is that he relied on this idea of social proof. So many of his investors were brought into the Bernie Madoff's hedge fund through their friends and others in their network, etc. So people invested in Bernie Madoff's hedge fund on the basis that their friends recommended it and didn't do their own due diligence. And we saw this in FTX. So FTX attracted some of the largest venture capital firms in Canada and the US. It attracted celebrities like Tom Brady, the football player, Gisele Bündchen, the supermodel, Steph Curry, the basketball player, and our own Kevin O'Leary. And I think the challenge is that many investors saw big investors coming in and large celebrities coming in and see that as almost a stamp of approval that they should follow in their footsteps without doing their own homework. And that's the second lesson that I think investors should draw from it.
Do your homework.
Do your homework. The third lesson is probably what your mother, and I know my mother used to tell me, is that if it sounds too good to be true, it probably is. So there are established standards for transparency, governance, etc. And if the company or investment violates those rules, I think you should dig deeper and ask why. So let me give you a couple of examples. Again, Theranos. Theranos refused to publish their data and results that were backing up their technology, something that is typical for any pharmaceutical launching a new drug or a new medical technology, etc. A warning sign. WeWork, the founder, Adam Newman, was able to negotiate a voting structure where he got 20 votes for each share that he owned. So ensuring that he was going to control WeWork to an extraordinary degree far into the future, no matter what other external investors came in. That's not typical in the investment world. And SBF and Samuel Bankman-Fried created a structure for FTX with over 130 subsidiaries, for ostensibly what is a fairly simple business, as he tried to put it out. Again, that is not standard or typical in the industry. So warning signs. And I guess the fourth lesson that I would encourage investors to take is, look, being a disruptor or a revolutionary or innovation, it sounds good, it sounds sexy, but we should remember that it is much harder to do that than it sounds. Usually disruptions or innovations take years to reach the mainstream, and there are many setbacks along the way. So look at the self-driving car or nuclear fusion as recent examples. Sure, we've made some interesting breakthroughs, but we should all remember that a viable commercial solution for either of these is 10, 20 or more years away. So be careful to anyone that is telling you or promising you riches from disruption, that disruption is around the corner. And I think those are the four key lessons that I was trying to highlight for investors so that they can avoid the next FTX. Because I guarantee you, and it is coming. So it will be there.
So number one, be aware of the celebrity CEO. Number two, do your homework, do your own due diligence. Number three, if it's too good to be true, it probably is too good to be true. And number four is disruption, major disruption, industry disruption. Takes a long time. It's not going to happen overnight.
Correct.
Is that fair?
That is fair.
Excellent advice. We're going to take a break for some messages and come back with Sam in just 2 minutes and talk a little bit more in detail about FTX, what happened, and then we're going to turn to the markets generally in 2023. Stay with us, everybody. Welcome back, everyone, to the Brian Crombie Radio Hour on Saga 960. Really interesting to chat tonight with Sam Sivarajan. He is just a really smart guy. He is a behavioral scientist, and I think it'd be interesting if we get into behavioral economics versus sort of regular economics, and how behavior is plays such an important role in investing decisions. He has led wealth management teams in some large Canadian financial institutions. He's a columnist with the Globe and Mail, and that's where I found him, where he wrote a really interesting article recently on FTX, a leading cryptocurrency exchange that went bankrupt last year. And the CEO is now in the United States facing charges with fraud. And I think that's going to be a story that we're following quite a bit in the next couple of months. And he's outlined 4 lessons that we need to be mindful of in our opening. And if you missed them, they're really quite interesting. I'll repeat them later on as well. But it's be wary of the celebrity CEO. Do your homework. If it's too good to be true, it probably is. And disruption, market disruption, industry disruption takes a while, longer than sometimes we think. I wonder if you could take a step back, Sam, and just tell us cryptocurrency. Is the cryptocurrency market real? Is it a valid market, or is it like Warren Buffett and Charlie Munger talked about in regards to sort of just gambling in a casino in Vegas?
Well, it's an interesting question, and I'm sure I'm going to offend a number of your listeners in saying in making my comments. But let me plow ahead, anyways. My own personal view is more along the lines of Warren Buffett and Charlie Munger, etc. I do think that cryptocurrency is more hype and than a real investment, and I'll say that for a couple of reasons. Number one, an investment has a return that is generated through profits, revenues through a product, etc. Cryptocurrency, to the best of my knowledge, whether it's a Bitcoin or anything else, you're effectively speculating that somebody's going to pay a higher price for your Bitcoin than you paid for it. And the only thing driving that higher price is hype and momentum, etc. So there is no real underlying business. Now, the key thing that I would say is that what's underlying cryptocurrency, blockchain, which is a distributed accounting framework, I think that's promising. But I think we're barely at the surface of what blockchain can do. So I think that cryptocurrency as an example of blockchain may not be a particularly good investment, but blockchain could be. And the analogy I would draw is Web 1.0. When the internet first came out, 20, 30 years ago, before the tech wreck, we had companies like eToys, for example, which was going to put Toys R Us out of business because they were selling toys on the internet, without bricks and mortar, etc. eToys went bankrupt. Toys R Us went bankrupt, but 20 years later. But the difference is that Toys R Us had bricks and, had the logistics, had the buying power, had the systems to be able to identify the next big toy, etc. And so even though the first set of companies that were exploiting the internet, failed, the internet itself was a good underlying technology. And we see companies like Amazon and others that are very successful today using that technology.
Well, maybe that's one of your lesson 4s, that the disruption took place, but it just took 20 years.
100%. And that's a great point, Brian, and in a slightly different way and format than what people might have thought it did when it initially came out, the technology.
One of the things that really surprised me is that teachers, the Ontario Teachers Pension Fund, had such a sizable investment in FTX and had such a significant loss upon the bankruptcy. Why did some smart, sophisticated investors like teachers, like I can sort of understand Tom Brady and some of the supermodel and super athletes and actors, etc., that got on board because of the hype. But what about What about teachers, one of Canada's largest pension funds?
Well, I think that's a great question. And by the way, it wasn't just teachers; it was also Sequoia Capital, which is one of the largest VCs and most successful VCs out of this Silicon Valley. Look, there is a variety of reasons, and you talked about the behavioral aspects of it. And so let me draw on potentially two explanations. So one is, and I think this is a phenomena that affects not just individuals, but also big institutions like teachers or like Sequoia, et cetera. And that is FOMO. We're all human, you know, whether you're a big firm, a sophisticated VC, or an individual like Tom Brady or Kevin O'Leary or Sam Sivarajan, we all are susceptible to the fear of missing out. We see everybody else, making money, and I put that in quotes, and we're afraid of missing out. And so, we allow ourselves to be, taken along with the euphoria that comes around this and the hype that you read in the paper. And I think the second related behavioral concept is something that's called motivated reasoning. Or you can also hear it as referred to as confirmation bias. So, we've heard about cryptocurrency. We see that it's going on. We're afraid of missing out. And so what motivated reasoning and confirmation bias does is that, we start focusing in on the reasons or arguments or data points that support our view and ignore the ones that don't support our view. So if you're a crypto bull, you're going to be focusing on the fact that, Sequoia invested, that teachers invested, that others are investing, and that, that some smart people are hyping the future of cryptocurrency, and you're afraid of missing out. And you're going to ignore the Warren Buffetts or the Charlie Mungers of this world that, and you're going to sit there and say, they're just old fashioned. They don't understand this technology. And I think those are two reasons that I think, sophisticated people get caught up in it. And I think those are reasons that aren't going to go away and aren't affecting only the amateur investor, but affect the smart, sophisticated investors, as you point out.
Sam, I've also always, wondered if there's another. It's the way we evaluate our portfolios and our portfolio managers. And I had this explained by a wealth manager to me at one point in time, and maybe given your experience, you'd be able to comment on it, that it's very difficult to be a contrarian, because if Bitcoin FTX is going up like crazy, and therefore other people's stock market portfolios, funds, whatever that you're looking at is going up, and you don't believe it makes sense, and so therefore you're a contrarian, you're going to be posting really lousy numbers in comparison until you're actually proven right that the thing goes down. But by then it's too late, because you missed out on several months, quarters, years of this massive appreciation on something. And so therefore this person said, given the way that we evaluate portfolio managers, given the way we evaluate our stock market portfolio relative to the index, if something's taking off, even if we disagree with it, it's really difficult to be a contrarian. Is that true?
Well, no, I think that's 100% right. I mean, it doesn't mean you shouldn't do it, but I think but I think your comment and the previous guest's comment is absolutely right. If you're a portfolio manager and you are telling your clients that I'm not invested in this in this hot trend, et cetera, because here's the reasons why, they may believe you, but as the news comes in and everybody else is seeming to be invested in it, and this investor is not, the portfolio manager is going to be getting an earful from this client and other clients, and eventually those clients are going to walk away to somebody else that is invested in that trend, etc. The portfolio manager is eventually going to be proven right, but to your point, probably not soon enough to keep their job. So what many portfolio managers will end up doing is throwing in the towel and buying into something that they don't necessarily believe in, because they feel that they have to do it from a business perspective. That doesn't change the fact that it may not be the right investment. But again, this is another behavioral component that affects all of us to sit there and say it's pretty hard to buck the trend. It takes a lot of guts and staying power to go against the tide, as you pointed out.
So if you've got this fear of missing out, if you've got this confirmation bias that you talked about, if you've got this difficulty of bucking the trend that you and I have just spoken about, what's a regular individual investor to do? How can you avoid these kinds of tech bubbles, financial bubbles, Bitcoin bubbles in the future? What do you do?
Well, it's interesting that you asked that. Like, my belief, and one of the things that I write a lot about, and that I helped launch two of Canada's largest institutions, is a approach I call goals-based investing. And what it does is goals-based investing focuses ultimately on the client's goals. So whether that is saving for retirement, or saving for kids' education. And what goals-based investing does is it customizes or personalizes an investment strategy that is geared towards achieving that goal, and allows the investor, by and large, to kind of ignore the noise in the market, whether there is a hot stock trend, whether there is a fear in the market or panic, etc. It focuses, again, it emphasizes to investors that focus is on achieving the goal and not beating the benchmark or not following a trend, etc. And what I've seen, and this is the way I invest myself, is that it tends to help investors focus more on the goals and ignore the noise. Now, that's not easy. And one of the things that I've seen a lot of investors do is put 80-90% of their portfolio into something like a goals-based investing strategy that focuses on long-term and avoids the noise, while keeping a small portion of the portfolio, 10% or so, that allows them to play with trends, etc. I think it focuses on human behavior. Telling somebody from a fitness perspective that you should be eating salad and eating healthy is not going to work. But what's more likely to work is if you allow people to have, the occasional dessert or the cheat meal, etc., so that they're not feeling deprived of indulging in their passions.
Sam, if we were chatting a year ago, not many people thought that inflation was going to skyrocket. Governments were still putting a lot of money into COVID-related deficit creating programs. Some people were worried about Russia invading Ukraine, but most people thought Russia was never going to be dumb enough to actually invade, that we wouldn't have it. People thought that COVID was sort of coming to an end. And lots of things changed last year. We had the biggest stock market decline since the Great Recession. Housing prices that people a year ago and certainly a year and a half ago thought were going to skyrocket, continue to skyrocket, have come down, and volume has come down precipitously. Interest rates have gone up, and it's the steepest and quickest increase in interest rates, I think, in history. What's an investor looking at 2023 supposed to do?
Well, that's the million-dollar question, Brian. And unfortunately, no one has a crystal ball. I certainly can't pretend that I do. But I think there is an interesting parallel that maybe investors and your listeners can draw comfort from, but looking at the so-called lost decade of the 2000s. Your listeners will remember that this was a period, I'm talking about the period from 2001 to 2010. This was a period that had two big market downturns. The tech wreck that we already spoke about a little bit, as well as the Great Recession of 2008, 2009. Now, what is interesting, and I've looked at this numbers recently, is that someone who invested in the top 500 companies in the US, so as represented by the S&P 500 index, would have, at the beginning of this period in 2001, would have lost almost 8% of their portfolio over that time period, over that decade. So that's one of the reasons why it's considered a lost decade. But I think if you dig deeper, the issue is there's some silver lining there. These companies in the S&P 500, most of them pay a dividend. And if you consider dividends as being paid and then reinvested in the portfolio, the same investor investing in the S&P 500 in 2001 would have seen their portfolio grow by 11% over the decade. So that's a 20% swing that the difference that the dividends and reinvesting in the dividends make. So to me, this is not a lost decade. And what that parallel reinforces to me is the importance of investing in a diversified portfolio of companies that pay dividends, reinvesting those dividends, and investing for the long term. Now, that's not a magic wand, but I draw comfort, and I think that investors should draw comfort that if that was the case in the lost decade, that is probably a good advice in the volatile months and years ahead. Because I agree with you that I think 2023, 2024 is going to continue to be a bit volatile, and there will be headwinds. That's as far as my crystal ball goes.
Now, looking for the long term, investing for the long term, and sticking with it would be something that Warren Buffett would agree with, I think, and has suggested. One of the interesting things that you comment about is dividends and buying dividend paying stocks, which tend to be a little bit more sort of established quality companies rather than the sort of startups or tech or companies that are, growth oriented. I used to be in the pharmaceutical business and loved to take a look at biotech stocks, but they don't pay dividends typically, not for a long time until they're into the sort of the stabilization. So tell me, why is the paying dividends criteria so important to you?
So I think that's a great question. And I would clarify to say, I'm not suggesting ignoring tech and biotech, et cetera. I think there are growth companies that make sense. And I think that, they should be a part of people's portfolio. What I think dividend paying companies, why they're attractive, is that it forces a discipline on those companies. They need to generate a profit, and they need to hand over a portion of that profit to shareholders. So it avoids a situation that investors are hanging on to a promise of future growth. It's having your cake today, instead of waiting for 10 years to eat it, etc. So I think to me, what is interesting about dividend paying stocks, and I think that Warren Buffett's strategy, is that it keeps companies and their management honest in order to generate profit so that they can meet their dividend obligations, instead of investing in, and we talked about it earlier, disruptive technologies, only focusing on disruptive technologies that may or may not pan out, and that depend, and oftentimes, on things that are completely outside the control of the company.
Interesting strategy. I think it makes a ton of sense. I appreciate you describing it and outlining it for us. We're going to take a break for some messages, and we're going to come back, and I'm going to ask Sam a little bit about his background, about behavioral economics, and about the implications of all that on his experience and how he thinks that that's applicable for the rest of us. Fascinating conversation I'm having tonight. Stay with us, everybody. We'll be back in 2 minutes. Welcome back, everyone, to the Brian Crombie Radio Hour on Saga 960. My guest today is Sam Sivarajan. He is the author of 2 best-selling books, a behavioral scientist, and he has led wealth management teams for large Canadian financial institutions. He's also a columnist for the Globe and Mail and writes on investing and personal finance topics. I read a recent article that he wrote about FTX, a leading cryptocurrency exchange, its bankruptcy, and some lessons he had. 4 really great lessons that we talked about earlier in the show. We're going to repeat later on for people. And I was fascinated by FTX and the incredible acceleration in its stock price, and then its
Mhm.
unbelievable demise. And it really is it's going to be one of those stories that I think that we read about over and over again. Sam, let's take a step back, please, and tell me a little bit about you and how you got involved in the investing business.
Well, Brian, so a little bit about me. So I was born in India, moved to Canada as a very young child when my father, who was an engineer, he was working for a Canadian company in India, and they transferred him to Montreal. So I grew up all over Eastern Canada, went to a number of different schools, and I met my future wife in grad school in Toronto, and she was an exchange student from Austria. And then we ended up, once we got married, we lived and worked in London, England, where my daughter was born. And then we moved back to Canada and have lived here for the last 20 years. So we joke at home that the only Canadian born member of our family is our dog, Rocky. But joking aside, I think I'm grateful for this diversity of experience, international experience, because I think that it's helped me broaden my perspective. And I think it has helped me become a better investor and investment manager.
What
So one
was
thing I learned,
what was living and working in London like?
well, this was the time when it was cool Britannia, pre-Brexit and everything else. It was fun, but it was expensive. London is a very expensive town to live in, and you know, my Austria is where my wife is from is also expensive. But you know, I think, as in everything, I think everything is relative. So, you know, before I lived in London, I thought Austria expensive. After living in London, Austria is relatively cheap in comparison.
Were you in the wealth management banking business in London?
So I was actually in the investment banking side of the business when I lived in London. So working with large companies in the telecom and technology space, working on IPOs, mergers and acquisitions, you know, still in the financial side of things, but more advising on the strategy for large companies, and a lot of travel, a lot of long hours, etc. And you know, towards the tail end of it is when my daughter was born, and we decided that you know, we needed to settle down, and moving back to Canada, back home to Canada was what made sense. And then I switched into investment management so that you know, I could actually also have a family life and a personal life, rather than just jetting around the world for work.
I used to be in the investment banking business a little bit myself, and at the time, which was probably long before your time, you know, London was almost the equal of New York. It was unquestionably a financial center. And Brexit really has caused a lot of changes. A lot of the banks in London started opening up offices in continental Europe, moving people there. The economy
Yep.
hasn't done as well. And it was interesting during Brexit that London, in a fairly large majority, voted to stay in the European Union, and it was the industrial places and the north, sort of you know, the comparable of middle America, whatever you call that, in the UK, that voted to leave, and hasn't worked out all that well. What's your assessment of Brexit? Was it a good decision or a bad decision?
Look, as I've lots of friends in the UK still. You know, my daughter is a British citizen. I'm a British citizen. And as a citizen of the world, I think, yeah, you know, my perspective is that Brexit was, you know, probably not. That's my own personal perspective. Is a move backwards for the UK, and I think that the, you know, we're seeing some of the, call it, growing pains, teething pains of Brexit that is occurring right now, and I think the UK has to figure out a way to deal with it. The challenge, I think, is, but I think you make a great point, and I think that without getting into the politics, I think that's a whole different conversation. I think the reality, I think you make a great point that the way the UK voted for Brexit, you know, was different region by region. When London voted to stay within the European Union, and Northern England, etc., voted to get out of the European Union. And I think it's easy to kind of caricature that kind of picture, and I think the nuances and it's far more complex. I think there is no doubt that the benefits of globalization, etc., were favored London. And I don't know that all of those benefits necessarily kind of made its way to Northern England, or Middle America or Middle Canada for that matter, etc. So it's, I think, and the voting, whether we agree with it or not, I think the voting and Brexit reflected the fact that people were frustrated that the so-called benefits and advantages of globalization didn't reach them.
I think there's a huge lesson in that, but that is maybe more political, and so we should probably leave it for another day. But I do think there's a huge truth and lesson in what you just said. You spent, therefore, time in investing in the UK, a lot more time in investing in Canada. What have you learned through that process?
Well, I learned a lot of things, but I think one of the key lessons I learned is that investing is simple, but not easy. And I'm not trying to be glib, but what I mean by that is that it is simple, because investing is not rocket science. I mean, the fundamental principle of investing is buy low and sell high. How hard is that? But the reality of it is hard. It's not easy. And I learned this the hard way. As a student, invested money in a can't lose stock tip. I guess you can guess where I'm going with this. What can I say? I lost. It hurt, but thankfully only enough to remind me never to do that again. So even now, even more than 30 years later, now I have not forgotten that lesson. And I learned over the period that knowing the mechanics of finance is not enough, but that understanding emotions and psychology, human psychology, investor psychology is equally important. That's why I ended up doing a doctorate in behavioral finance, because I was fascinated with this topic.
You did a doctorate in behavioral finance.
I did a doctorate in behavioral finance.
Oh my gosh! And what was your thesis topic?
It was actually the idea of about how investors make decisions, how they think about risk, and how we're measuring risk, whether that is accurate. Is it an accurate indicator of how much risk people actually want to take and do take?
Fascinating. I'd love to read your thesis sometime. That sounds interesting. Let me ask you a question on this. Buy low, sell high is something that you said that seems obvious, but it is really difficult to do. And let me take you to the real estate market. When everyone's buying and prices are skyrocketing, it seems like everyone wants to jump in, but the market's already at a high, and we shouldn't be buying in more. We should be logically selling, but we're not, because the psychology is all about the market's on fire, prices are going to go up forever, and people keep coming in. And then when the market starts going down, as it has in the last little while, nobody shows up, because we're all afraid of making a bad decision, thinking it's going to go down forever. So it's almost as if we're doing the opposite. We're buying high and selling low. What 100%. The heck is going on there, buddy?
Well, look, I think it's what we talked about earlier. I think this is the idea of fear of missing out and the emotional things that we see with FTX. I think, and doing your own homework. I think it's hard bucking the trend. And I think, look, and it isn't helped. There's always people that are, let's use the real estate example, the housing market. There was lots of evidence. There's lots of data that was out there that the Canadian housing market was highly valued, among the most highly valued in the world. And to me, it was funny that those commentators that were making those kind of pronouncements were non-Canadian. So it was international, organizations, the OECD, the World Bank, hedge funds in the U.S. rather than Canadian commentators or Canadian institutions, etc. And there was almost this idea that, okay, yes, the valuations are high, but we were looking for, this is the motivated reasoning and confirmation bias I was talking about earlier, which is that like, yeah, but Canada's different. Yes, this is a wonderful country. Yes, and people are coming. It's still cheaper than Shanghai. It's still cheaper than New York. It's still cheaper than London. And I'm a very proud Canadian. But I'm also an investor, and I think that I love being in Canada. It's to me, we moved back. It's home. But I also wouldn't compare it to Shanghai, London, or New York. I think that the people move to London, New York, or Shanghai for different reasons than living in Canada, and it doesn't justify a valuation that is similar to those cities. And telling ourselves and allowing ourselves to feel comfortable that we're cheaper. Housing market in Toronto is cheaper than it is in Shanghai or New York. I think misses the point. And I think that's part of it. Like, I think this is human behavior, that we look for evidence that supports our views and ignore evidence that doesn't support our views. And that's true in the housing market or in the stock market.
You suggested earlier that something called goals-based investing is a better approach. Explain that to me, if you could.
So, yeah, so the goals-based investing approach, there's lots of people that have written on it. I've written a bit on it, and I've launched 2 goals-based investing platforms at 2 large Canadian financial institutions. And before I describe it, I'll just say that I'm passionate about it because I think it works for everyone, not just the very wealthy. And my clients love the approach because they immediately understood the philosophy, they trusted it, and were able to move towards their goal even in noisy markets. So one of the things, I think what goals-based investing does is it addresses 2 of the biggest obstacles that I think investors face in achieving their financial goals. So the first one is conflicting goals. So most Canadian investors have multiple financial goals. They save for their retirement. They want to save for their retirement. They want to pay down their debt. They want to help their kids with their education costs or buying a home. But the reality is, Brian, as you know, is that usually these goals have to be prioritized because there isn't enough time or resources to do all of them at the same time. And the investing, strategy will have to be personalized or customized for each different goal. Let me use fitness as an example. We're in January and people are going to the gym, and they go, with typically the 2 goals. So typically a goal of losing weight and gaining muscle, but they're different goals. They're 2 different goals. And what that means is that you need to train and eat differently for those 2 goals. And I think a one-size-fits-all strategy will not help a person achieve those fitness goals, both those fitness goals. And I think it's the same thing for investors. And unfortunately, that's something that isn't addressed properly. The second obstacle that investors face is thinking that risk is one-dimensional. And this comes from my thesis as well. So what do I mean by that? Risk is multidimensional, but let me focus on 2 dimensions of risk. The first is volatility. It is a standard measure of investment risk, and it simply is the variability of returns. The price of your investment goes up and down. What we see in the newspapers, in the stock market tables. But one investment that has 0 volatility, savings account at a Canadian bank. So if you put $100 in your savings bank at the beginning of the year, you're pretty in your savings account at the beginning of the year. You're pretty well guaranteed to be able to draw out that $100 at the end of the year. However, that 0 volatility comes at a price, and that price is a very low return on investment. The second measure of risk, dimension of risk, is shortfall. And to me, and in my experience, this is the risk that most investors are concerned about. Running out of money or not having a target amount at some future date. So again, in the housing example, saving a down payment of $50,000 to be able to buy a house in 5 years' time. But here's the thing. In my view, volatility and shortfall risk sit on opposite ends of a seesaw. So if you want lower volatility risk, i.e., like the kind of what you get from a savings account, you have to accept higher shortfall risk. That you have a larger risk of outliving your money in retirement. And this is where goals-based investing helps investors. It helps clarify and prioritize the goals. It helps the investor outline and implement different strategies, customizing strategies for each different goal. Knowing that the goal that you have for saving for retirement in 25 years from now, you want to take a different level of risk and a different time frame and a different type of investment strategy than saving for a down payment that you need in 5 years from now. And the last thing that I think that goals-based investing does is it helps crystallize this balancing of risks between shortfall and volatility and other risks, because they're different for each investor, different for each goal. And goals-based investing allows investors to do all of this, reach their goals while still being able to sleep soundly at night.
Fascinating. Great advice. We're going to take a final break and come back with some concluding comments from Sam in just 2 minutes. Stay with us, everybody. Welcome back, everyone, to the Brian Crombie Radio Hour on Saga 960. My guest tonight is Sam Sivarajan. He is a behavioral scientist. He's a wealth management investor and advisor. He's a columnist in the Globe and Mail. We've been talking about FTX. We've been talking about cryptocurrency. We've been talking about lessons learned. It's been a fascinating conversation. Sam, if people want to know more about you, if they want to check you out, if they want to read some of your stuff about goal-based investing or buy your book, how do they do that, sir?
Well, Brian, you can go to my website, www.samsivarajan.com, where there's links to buy my books, where there's the articles that you reference from the Globe, as well as talking about risks and goals-based investing. You can all find it on my website.
samsivarajan.com. Thank you so much. Wrap it all up for us. What are some good lessons learned that you've learned? Or what's your message for everyone that is looking at the markets right now?
Well, look, I think it comes from FTX, but it's investing in general. And I would say life decisions, which is my second book, and more generally. So, a few lessons to take away. Number one, don't blindly follow the crowd. Do your own work and due diligence. Number two, understand the gains as well as the potential losses from your choices. And before you make those choices, be comfortable with both. Number three, consider the trade-offs. Every decision that you make means that you're trading off something else. And, be comfortable that you're willing to accept that trade-off. And number four, this is an important one. Test your assumptions. What has to go right for this decision to turn out as you would like? What could go wrong? And most importantly, what is in your control and not in your control that's going to affect that decision? And finally, I think is think and act for the long term. I think we have to make course corrections. The analogy I use is GPS. You can set your destination, but just because you go there, but just because there's road construction or traffic doesn't mean you give up and turn around and go home. You make course corrections to get there. And I think this is the right approach for investing or life in general.
Sam Sivarajan, really appreciate you sharing your expertise and knowledge with us tonight. If I could add one more, and I think you've really covered it, but if I could add one more, because I think it's what you said, and I think it's the most important, which is buy low and sell high. And I think behavioral attitudes, behavioral economics, whatever, often makes it very difficult for us to be a contrarian and actually buy when things are out of favor and low, and sell when things are in favor and high. And yet that's what we all think we should be doing, buying low and selling high. But it's very difficult to do it. And so I think if we can think about being a contrarian and buying when things are out of favor and selling when things are in favor, we'll be a lot better off and make more money and be happier in the long term. But that, by definition, is going to be bucking the trend. And so it's challenging. Anyway, Sam, I really appreciate you joining us. And I appreciate all of you, our listeners, joining us tonight. I remind you, I'm on every Monday through Friday at 6 o'clock on 960 a.m. You can stream me online Sam, even from London, England, if you go there, or Austria, at www.saga960am.ca. All my podcasts and videocasts are available on my website, briancrombie.com. Sam, Sivarajan, thank you so much for your expertise, sir.
My pleasure, Brian. Have a good evening.
Good night, everybody.